Daniel, it's such a pleasure to have you back. I think the last time I spoke with you was back in January 2021. That's like 2.5 years ago. We both can agree a lot has changed. How have you been?
I've been well. Yeah. January 2021, right about the peak of meme mania. A lot has happened in the last 2.5 years. That's for sure.
There are lots of loose ends to tie since the last time we spoke. We were in the period where SPAC stocks was kind of a thing. Tech stocks were going up. We spoke about SaaS companies like Dropbox, travel companies like Booking.com. You did have a stake in Booking.com when the whole travel industry was recovering. So I'm actually curious to know, how has that investment turned out for you?
So booking has turned out pretty well. I didn't look at the numbers, but it was probably close to 2000 then, and it's at about 3000 now, 3100. What's been interesting about the market is it's very much the bullwhip effect, the fast recovery, but then the hangover or the fast climb, and then the COVID hangover, all this stuff where it's hard to get a steady flow and it feels very short term cyclical. And with travel, yes, it's definitely revenge travel. And there's definitely still, I think, energy from people being trapped in their homes for COVID and so on. But also, I just think travel is a secular theme that's going to be really powerful for the next decade or so. I don't have a time frame, but it's going to be a long time where travel is going to do well. And booking is a dominant player. I think people in the US underestimate how powerful bookings market share is in Europe and Asia. They're a global company and they're just in strong financial shape. They perform well. They are trying to buy back $25 billion worth of shares over a 5-year period. Not trying, but they have an authorization. They're very thoughtful about share buybacks and about share-based compensation. They've switched their model a little bit to be more, I forget the terms off the top of my head, but merchant-based, where they're taking the payments up front, which is improving their cash flow dynamics. I sold a handful of shares a few weeks ago, but it's a top 10 position for me, and I don't really have much plans to change it for the time to come.
Yeah, I think it's crazy. If we look back the last 2 years, if you didn't sell your stocks, I think your returns been pretty significant. There's been a lot of turbulence over the past couple of months, I'd say, with the Fed raising rates, and there's a lot of speculations that they might pause and all of that. And I want to sort of rewind back in terms of helping my audience understand what kind of investor you are. I was reading the transcript in our last episode. You said ultimately investing is giving people money who may be able to grow it in the future. And you said that you're an optimistic person, but you're also skeptical. So it's interesting to see whether your investment philosophy has changed over the last 2.5 years. Maybe it would be good to get an update from you on that.
Yeah, it hasn't changed dramatically. I'm still always trying to learn and trying to improve, not so much philosophy, but tactics. But I think a couple of the things I took away from 2021 was it was another crazy bull market year. And I pretty sure, I don't have my numbers in front of me, but I think I lagged the market that year. I had a lot of cash and also wasn't in meme stocks generally. And the one that I was in did poorly, which was Stitch Fix. 2022, I lost money, but was ahead of the market. Again, cash helped. And I think what I learned just in both periods was to trust my instincts a little more and to focus on what I know and just what I'm comfortable with. I think you mentioned last time we talked a lot about SaaS companies. And at the time, I was trying to incorporate growth and play the game that was in front of me. And the game at the time was growth. And not that that was wrong. Like there's a stock I have that's an interesting example of how if you're thinking in a shorter term time frame, I could have adjusted the game I was playing, but it's worked out anyways through the last 3 years. But Dropbox is a decent example too, because I still own them. And Dropbox is a boring company. They don't grow very fast. They are the original public SaaS company to some degree, I guess CRM, but they're the original sort of next gen SaaS. And I don't know how great their future is. And they're throwing around AI now and getting some buzz around that and so on. But it's still a file storage with some add-ons company. But it's a company where I felt like I could put a lot of money in it and not really worry that it was going to dive off a cliff the way that some of the other more sexy SaaS names have. And they never really had a huge hangover. They never had a huge climb. They were never an angel. But that's the sort of reasonable valuation. I can see that they're going to grow. I understand what the business value is. I'm a user as well. I think with Peter Lynch, I'm cautious about overselling my experience, but I do still think I understand booking as a user and as somebody in my professional life because booking is such a leader in conversion. So I do try to incorporate that, but I think what I've tried to adjust in the last couple of years is to retrench and focus on what I'm good at, which is understanding at a general level what a company does, understanding who knows what they're talking about and who doesn't, and then zeroing in on reasonable valuations where I can see a return coming in the next 2 to 3 years. And then hopefully, as that comes, the business grows and I can continue to see 2 or 3 years ahead, which adds up to a long term holding.
And I think it's very interesting to see growth stocks and or growth companies really recovered over the last couple of years and spectacular earnings. We see Nvidia and Adobe and Salesforce
Mhm.
doing well recently on the earnings. Given that we talked about SaaS companies and a major component of their business model is subscription. They've made so much money from the subscription business model and they're able to scale their business. And I know that you've previously worked for content-based subscription or financial media companies such as investing.com and Seeking Alpha that endorses a subscription-based model. How do you think these companies have benefited from the subscription economy?
Yeah, it's a good question. And I think it's also one that even in though since we talked and from before, like it's changed as a dynamic. And very quickly, as an example, with investing, when I joined, it was all about growing ARR. And then as the bear market kind of came into play and everything else, all of a sudden it was just back to revenue. We just care about revenue. We'll worry about ARR later. ARR was still a goal, but it became demoted. So the focus on subscriptions decreased a little. I think financial media, there's going to be echoes to what a tech company does, but media is a little different in terms of subscription. The attractive part of a media business is, in theory, that it can scale. That if you produce a good piece of content on finance, it'll be interesting to you. And then if you hear about it and you tell me about it, it'll be interesting to me. And it won't cost the company very much to acquire that. So then it scales nicely. Investing.com is a company that has a seller's DNA and that is very good at acquiring users. It's very good top of funnel. They bought the domain name over a decade ago, which I think is a big piece of it, but they also are very good at SEO. They're very good at paid user acquisition and everything is top of funnel for them. And then historically has been top of funnel, take them to the site, funnel them right back out to a broker. And that's sort of the base of the business. They have some other things, but that's really the moneymaker. They bought a company called Finbox in 2021, I think. They bought another company that I oversaw for the integration period, which was Street Insider, a content company. And they wanted to go into the subscription business, but I think there wasn't quite the understanding of, okay, but to build a good financial media subscription business, you have to deliver value. And ultimately in finance, you have to help people make money more sort of directly. Like that's ultimately what they're paying for. And I think there wasn't enough of a, okay, we need to invest in that so that we're willing to build the content funnels and build the flows that will help people understand that they can make money through whatever, whether it's the tools, whether it's the news, whether it's investing ideas or so on. They implemented Finbox, they white labeled it as Investing Pro. They were able to sell it well and they learned the wrong lesson, which was, oh, we can sell anything. So we don't really need to build up. You have such an audience that we can sell. What's attractive, to get to the core of your question, is that it's recurring. It's in theory predictable. If you reduce churn, it keeps people along. So that's what's attractive about it. And I think Seeking Alpha, for them, they learned that lesson and I think they always wanted to. I think the CEO, David Jackson, I don't know if he's publicly said this, but I don't think I'm giving away. I think he believes more in a subscription model and ads was always something of a necessary evil. They don't have ads on the site except for their own products, which gives a clarity because then everything is, you're focused on the same goal across the organization. Everything flows to how do we grow subscription revenue. I think that the challenge for them, you're adding value towards the subscription, but then you have to balance that with user acquisition and how do we still bring people in? And the paywall, I think, is quite unpopular, not surprisingly. And in the end of the day, what happens is that I think they may have tilted too far towards how do we make a great product without burning the non-paying user population. How are they going to grow from there is the challenge for them. I haven't been inside there for 3 years. So that's sort of how it's played out for them. I think it's viewed as very attractive. It's viewed as something that will power your business and stabilize it. I think going into 2022, people would say, oh, it's much more stable than the ad business because ads flow up and down. A bear market, this was sort of the first prolonged bear market we had for a long time. Maybe 2018 is the exception. People canceled their subscriptions too. Like all of a sudden, you talk about a subscription game, but if people are losing money in the market, they're not going to pay you more money to lose money faster. And so that's a tension there. But yeah, I think they're good examples because they're differing companies. It kind of shows how a subscription is not one size fit all, and it requires more than just saying we want to sell a subscription. You have to kind of really commit to, okay, what are we offering by building a subscription? What's the value? How is it going to help people ultimately make money?
Given your industry experience, how does a subscription based business model create shareholder value? I think there's two parts that I wanted to ask, but maybe the first part, how does a subscription based business create shareholder value?
I think it creates predictability. Like in terms of what about the subscription versus it not being license based or being some or the other model in media, you talk about ads or the old cable model or what have you. I think it's the predictability in theory that with Dropbox that like they've shown over time that they can add users, can raise the price. So it's very easy to model, to understand. And then I know what they're going to do with that money. From shareholder value, that's the clearest. I think there's also changing market sentiments. It helps with the narrative too. And that's the point I made about ARR being the focus or not the focus. There are times where the market is just interested in that. And so it creates shareholder value just by default because people want to see that.
The second part of my questions, given your industry experience, how would you run a subscription based business model to create an even greater shareholder value?
It's hard for me to not think of this outside of content, right? So I have to kind of think about it in content, which is what I thought was great about originally how Seeking Alpha did it. And I think like they made the move to basically get rid of their ads team, I think in 2020 and go across the site paywall with some, metered so you can see a few articles. And so that's the easiest model for me to think about. I always would say to the authors on our what's now called investing groups that you want to deliver A plus value to non-paying users and to paying users. You want to figure out a way for people to say, that's good. And then for them to say, oh, but I'm missing out and I want more. And so I think where I would focus on is how do I build an acquisition funnel that is not super expensive? My cost of acquisition is reasonable. Even better, Spotify is a good example, which I also own shares in. Spotify makes money in theory. I think they're still struggling with it, but makes money on ads, delivers you a pretty good product for free. You have to hear some ads and you miss out on some features. And then for paid, you get X number more features. So the goal would be that you're happy as a paid free user. And I, as Spotify, am making money on you as a free user. And you're happy as a paid user. And, presumably I'm making more money as a paid user. What Netflix is going to do, I don't know how far along they are in the rollout, how many geos, but they're having an ad-based version that's cheaper is sort of an example of that and they are claiming their ARPU is higher for those users because they're making money on both the ads. The irony is that cable was sort of this solution back in the day to some degree, except nobody likes the company. But I think that's where you want to be, is where you're bringing people who are excited about what you're doing. So when they sign up, they're even more excited. Ben Thompson is pretty good at this in our world too, in terms of he gives away a little bit of content, tends to come across pretty well. And then if you're a paying subscriber, you're going to get good value as well.
It's really good to, get your insight, especially in the content industry, with regards to how do you drive readership. Financial media companies, they care about readership. They care about getting their exposure to the masses. There's going to be a question on the challenges and risks, but what do content subscription businesses care about?
We don't need to be too exotic. Ultimately, it's revenue, right? And profit. And what's good about content is that it costs time to create, but not whether it's video now with YouTube, whether it's audio, so on. There's some initial investment cost, and then it's your time. And that's ultimately the business, right? So however much time you have that you can spend on this, you can get your return. So they care about revenue, but revenue in a subscription business, like if you were to ask me, I'm going to run a Substack, for example, what do I need to know? You need to know, where are you going to find users? Where are you going to find people to just read your stuff? Do you have a big following on Twitter or on any social media platforms? Have you built up something on Seeking Alpha and you can somehow bring people away, which is hard? Where are people going to find you? What unique value you're going to bring them? In our world for finance, again, it comes down to, how are you helping them make money? You might entertain them. Matt Levine for Bloomberg is the best example. He's very entertaining. He probably still helps people understand the markets better so they might make more money. But I would say mostly you read it to laugh, and that's fine. But he's very funny and very smart, and it's hard to follow his example. So you need to have, what unique value am I going to be bringing here? Why will they read me instead of the next guy or the next woman's articles? Like, what am I going to offer that's different? And then the part that I understand the best is, what is my strategy for like satisfying the users who are not paying me, but then also delivering something extra for paying users that they're going to be excited about. And the non-paying user is going to say, ooh, I think I want that. And you're not going to get everybody, but then gives you a way to kind of try to continue to grow that top of funnel while converting. So a trivial example is, if you are focused on an industry, or you're focused just on investing in general, but you're, let's say, mid cap and small cap oriented, but you really understand how to analyze and have insight on large caps, then you write about the popular large caps that everybody cares about, NVIDIA, Apple, Microsoft, and so on. But you somehow, it doesn't have to be like a motley fool. This one small cap stock is what's really going to be the next NVIDIA. You don't want to be cheesy, but you get them to understand your expertise. But then you say, by the way, I'm focused more on mid caps. My subscribers get this, that, and the other. That's one way to think about it as a framework.
And speaking of the challenges and the risks, what kind of risks do you see associated with the subscription economy?
Churn and user exhaustion. I don't know how many subscriptions you have to things. I'm a content maniac. I started subscribing to the Boston Globe again a year and a half ago. That's where I grew up, and I love the Globe, but it's gone downhill a little bit. But the Celtics, when they went to the finals, I resubscribed, and I'm still stuck with it, right? So just as an example, I think people underestimate churn and underestimate how important it is to keep people on the platform so that you're not constantly spending money in some form or another to acquire users at the top. It's, again, the classic bucket funnel metaphor. If you're spending all that money and pouring that into the top, but then people are leaking out, you have to account for that. And the more you can manage to keep them in the bucket, the better. And so that's trivial. That's easier said than done. But I think that's the primary risk. The other risk, it's sort of a gating factor or table stakes. You do need people to actually know about you and actually care. Like, you can, and I'm not as good at this, at understanding how to build audience, but ultimately, if nobody's actually paying attention to you, you're going to be a little bit hoping in the dark for people to actually sign up, even if you have an amazing service. At Seeking Alpha, what we would do back in the day, I don't know if they still follow this, was you would ask somebody to write at least 10 or 15 articles on the platform. And we wanted to see that they would have 750 followers over those 10 to 15 articles, or however many they wrote, but with an average of more than 10 to 15 followers, just to see that if you can't get people to say, I want more for free, you're going to have a hard time getting them to pay for more. Whatever the business is, you need to see that users are using Dropbox and downloading it for free. You need them to see that they're using the hardware and might want a software on top of it, or so on. I would say the two biggest risks are keeping the users and then finding them initially. The rest is tactics that you can kind of work the flow out for over time.
I see successful companies, for example, Salesforce, they recently reported earnings that they have a gross retention rate of, I think, above 92%, which is really high. And I think as the net retention rate goes up, your customers will become less price sensitive towards your business model. Do you agree with that? Do you believe that consumers are, in general, less price sensitive towards a subscription based model as opposed to a traditional payment business model? How do you see the tug of war between price sensitivity towards subscription based models?
I don't know. I don't know that it's at the model level. That's where we should be careful to not ascribe too much to, which I think a lot of businesses right now they're doing with AI, but a year or two ago it would have been with subscriptions. We have a subscription model. Now everybody's going to be really excited. And it doesn't change that you're still offering food, for example. How important is the product to the people, right? I think that's the key gating factor. And if it's really important, they're going to grumble, but they're not going to be very price sensitive. If Dropbox is something I absolutely need, then I'm going to be really mad about and I'm going to have to pay more if they hike the price on me, and they haven't yet. If it's something that, well, I can go to a competitor like iCloud and I'll be fine, or well, I can back up everything on my physical hard drives or what have you, then it's just not as important product. So I think it still goes back to modes and how valuable is your service or product and how important it is it to people. The subscription has a passivity to it in that you're already locked in to some degree, but price raises generally are announced. And so they tend to remind you of it. Of course, there are businesses where Netflix might raise their price, but if I'm not looking that closely at my credit card bill, I just don't think about it. And so I accept the charge. But in general, I think it more has to do with outside of that 2% margin or whatever cases it is. I think it has to do with how valuable is the product.
I have Spotify, I have Netflix, I have Disney Plus, I
Mm,
have Adobe Cloud, I have my editing software subscription. I was looking at an article, a research conducted by the Subscription Service Statistics and Costs Research Report, and it says that an average consumer spends around 133 USD a month on subscriptions,
mm.
which is $1,600 a year. And in terms of my expenses per year is definitely more than $150. It's crazy how the whole subscription economy and how SaaS businesses have benefited from having a product that allows consumers to just access the product or the content anywhere, anytime, and save so much storage space. It seems like a sustainable business model.
I'm still paying for Adobe Premiere. 20 years ago, I was still in college. If I was doing this, I don't know if those products existed, but if I bought a software, I would buy it, right? It wouldn't be delivered over the cloud, might still be installed by CD-ROM, and I would not be able to get patches on bugs, but also I would just have the software and I have to learn with it, and I would be a one-off payment. I think for software in general, we shouldn't underestimate the value of switching to a subscription based where they're constantly updating and not just a minor version, but a major change that comes out. But in general, you're paying $20 a month, $30 a month, 300 a year, whatever it is for the different products. Yeah, I think I can hear where for software, that step obviously was fundamentally more valuable to them with a wider audience. Maybe not in the professional scale. In the professional scale, maybe you're still buying new licenses every year, but I think there's a case to be made. We can go back to Zoom, for example, and I haven't looked at their numbers recently, but there was the prosumer was often estimated. I remember my podcast co-host Akram would estimate that at 30 to 40% of their business. And that was where they were really struggling in 21 and 22. But that prosumer business, like the fact that they could sell that as a subscription, the alternative would have, I guess, been to charge a higher price for it up front, reap a one-time boom, and then have to figure out how to reinvest. Especially when you're not dealing with an enterprise level, I think it does make a big difference there.
We just talked about retention rates. Netflix is a very interesting one because I remember in April, Netflix stated that during its first quarter earnings that they were going to cancel password sharing for a lot of the users in the US and other countries. And I thought that was a bad move. I think that was going to piss a lot of people off and a lot of people would probably cancel their Netflix subscriptions. But recently, if you look at their earnings, it's like their revenues have gone up because of the crackdown and their number of users have increased, subscriptions have increased. It's very interesting how these subscription businesses have so much optionality in terms of, well, first, the features that they offer, and two is like they can just tweak a little in terms of subscription prices or the cost, and it would just inflate their balance sheets. So, what are your thoughts on that? I think it's very important for us to delineate a software subscription business.
I think we're just on the cusp of it. There's a huge difference between media and software. Even though Netflix thinks of itself as a tech company and so on, I think the difference is that they're providing content. They're using a ton of software and development to do that, but it's content. From a user perspective, a customer 30 years ago would still be paying for their content, their TV content in two ways, right? They would be either paying a cable bill, which we would call a utility, but was still basically a subscription, or they would be buying VHS, DVD, whatever your format is. And so I guess that's a license based way to buy. Early 2000s, I have like the Wire DVDs somewhere, but we didn't really buy TV shows. TV shows kind of lived on in syndication, and the money was in the back end of the studios. But from the user perspective, it was just on cable. And you would go to TBS and you can watch Seinfeld in syndication or whichever show in syndication in the US. I think from my experience in other countries that it's similar, where it's just a dominant cable experience and then DVDs for movies. And then, of course, going to the movie theater. So for Netflix, the benefits for them by building out the direct to consumer muscle, by building out the whole software flow, by building out the user relationship, and then at first being a clearinghouse, but then building original content, is that they were first to it. And so they could invest the costs up front. And so that's why they're reaping the benefits now. They could build that mind share so that they're building all the password sharing, but then when they decide to crack down, that was really a great test of what we were talking about earlier. How valuable is Netflix? How much do I really care? I saw, I didn't speak up in it, but when I was still at investing, I saw my Spanish colleagues grumbling, oh, how are they doing this? How are they? I'm just thinking from a, business model perspective, of course they're going to try. And as you said, I think I'm not a Netflix close follower of the stock in the company, but I do think they've done pretty well with the password sharing crackdown. And so I think that's a testament to, okay, we care about Netflix as a customer. And so they've built that connection. I think it's harder to make that one-to-one comparison. The closest thing we can see with those sorts of companies is price raises like we talked about earlier, but it's a little bit of a different, because it's content, it's a little bit different. And I think people have gotten smarter. I don't read their work super regularly, but just follow on social media Julia Alexander from Paradigm Analytics. And it seems like people are getting smarter in understanding what is churn-based content spend, meaning what retention-based content spend, what will keep people around, even though it's not really going to bring in new users. This summer in the US, I guess Suits was a show that blew up again. And it's just easy listening, sort of watching, versus what is spend that will acquire new users, like a Squid Game, like a Stranger Things, or so on. What will actually bring people to the platform. I think Netflix is further along in the journey of understanding how do we differentiate between that top of funnel and between what will keep the bucket from leaking and what will keep people around.
Talking about password crackdown, Disney just recently announced that they're going to crack down on password sharing, following suit in terms of what Netflix has done. Do you think the result would be the same for a stock like Disney?
I don't know the nature of what password sharing would be for them. Disney, their strength is that it's a family platform, that it's for kids. And so it's a must have. It's a tax on parents, is sort of what they say, right? If two parents groups, let's say you have kid and you're sharing it with your brother who also has a kid, and they crack down, like probably you would both need it. I would suspect that it is a must have product. In the US, there's Disney Plus and there's Hulu, which Disney owns 60%. Iger said they will buy the whole thing from Comcast. And it makes no sense to me why the same company would have two different subscriptions, because people hate having multiple subscriptions. And they also own ESPN. And it's unclear to me. I abroad am subscribed to both Disney and ESPN. In Disney, I get all the Hulu shows, which is like shows my wife and I like to watch. Only Murders in the Building, as an example of a show that isn't on Disney. But you also have a lot of other retention type shows or movies that I'll just stumble into and say, oh, okay, I'll watch this. And what I mentioned going back to Seeking Alpha and Investing.com is a clarity of vision and of, we're just doing this. Even now that they're integrating ads, it's still, we're delivering video content through an app to users in a subscription of some form. Yeah, we're going to add it with ads. Yeah, we're playing around with games, but it's such a clarity of vision. And I think Disney and, Iger gave that big interview on CNBC in July, and I think he's still struggling to have a clarity of what is it that Disney's doing? What is our purpose? How do all our pieces fit together? And then how do we monetize that? And it doesn't have to be just one way, but I don't think they've quite nailed that. And so I suspect they would be fine with password sharing crackdown. I think that that will work for them, but I think their bigger problems are, why do we have three streaming apps instead of one? Or how does this connect to our parks and so on?
This is going to be quite a tough question to answer. It's very broad, I would say, but what role does technology play in enabling the subscription economy? We see the emergence of AI softwares, and there's a subscription model packaged around it. What do you see in terms of how technology will play in terms of the future developments for the subscription economy?
This is not an original point. I don't remember who made it, but I think increasingly things that we call technology are just going to be technologies in everything, right? Uber is a taxi company or a food delivery company, but it's branded as tech and they have some subscription in their business, but not a ton. Walmart is very technology based and so on. Like it's just everybody's using technology. It's just the table stakes way to think about it. Technology, as we think about it, tends to be software, something connected to the internet, to the cloud, and so on. It is a very broad question, but I think that the way I would come at it is with the modern day, and it's continuing to evolve and change, but with the way the internet works, with the way social media works, with the way the planet works, it's easier to gain attention than ever in one sense. It's theoretically easier to just have a funny TikTok and all of a sudden you have a huge following. There's more competition than ever for that attention. And so building sticky connections, I don't know that it's harder than ever, but it's tricky. You mentioned last time we talked about shutting out the noise. This is sort of the reverse of that, standing out amidst the noise. That's going to be challenging. And so, in theory, a subscription is a way for you to get your hooks in once you do have a good connection. If you get somebody's attention, all of a sudden now they're paying you, then they're more likely to spend more time with you. And at least you're getting some money out of it in the meantime. AI is a decent example of this. In the SEO world, everybody's sort of still watching AI to see how does this change the search engine's display of content, and is this going to be a disaster because now they're going to be showing our content without linking to us, which has been the whole game. B, everybody's going to be using chat GPT or similar models to be churning out a lot of bad content just to game to SEO. That's going to be a cat and mouse game where Google and Microsoft in theory are going to want to not show that, but the AI is going to be, before I left investing, they were working on something to, like, they were exploring auto-generated content, which I was in charge of content there. I was trying to be open-minded, but I'm skeptical about it. I'm not super impressed with the value add, but they would try to figure out how to make it seem original. And the way, I think he's now the CTO there, but the guy who was consulting with us at the time was working on this. It sort of resulted in spelling errors, which, yes, makes it look original because you have a lot of spelling errors. It's not going to be AI generated, but it just was this sort of a snake eating its own tail sort of thing. And I think that's a risk in the content world, is how much value are we going to actually provide. But I think with AI in general, like, it's still too early to say, but the risk is that it increases the noise and increases the volume of stuff and makes it even harder to stand out and harder to make those customer connections.
I think on a practical level, I'm curious to get your answer on this. Do you see yourself subscribing to more AI softwares that have a subscription business model attached to it in the future?
I tried ChatGPT as a paid subscription for a month. A former colleague of mine has found it really helpful in coding, to be able to throw ideas at it and get coding solutions that he wouldn't have come up with himself and so on. I don't code. I don't know software well enough to use it for that. I haven't found AI super helpful for me. Generative AI, if we want to be specific, things like ChatGPT. If somebody's listening and has a good answer to this, I still spend way too much time looking at a company's 10K, compiling what was its 5-year growth rate in revenue, what was its 5-year EPS rate, what was its EPS for the last 5 years, what was its free cash flow, what was its EBITDA minus capex, like all these different metrics. And it's because I don't quite trust what I've seen out there for somebody to do it automatically. Even in websites like a Seeking Alpha or Investing.com will have financial statements, but they don't match how I do it. And so I don't trust that. It should be relatively easy in the scale of all these things for an AI tool to take my specifications and instructions and just do that. Yeah, I would probably pay for that. So like tools like that I can trust, but I think the trust is the hard part is to see like, yes, they've got it where I want it to be. Again, somebody listening to this either works for a financial company that offers this or that is smarter than me and knows how to do this. I would love to hear from them. But for me, that's been a hard one.
My lingering questions would be the same. This would be a whole nother podcast episode if we can get someone to answer that question.
Mhm.
From what I'm understanding is given that currently you have skeptical thoughts around paying for AI to help you like carry out a task, do you see yourself investing in an AI company? I mean, technically, if you're investing into Microsoft or NVIDIA, technically you believe in the future developments of artificial intelligence. So do you see yourself investing because there's AI element to the business model?
Probably not because my portfolio has benefited from AI somewhat unjustly, I would say. Like I have my biggest position as a semi cap equipment maker that sells equipment to semiconductor companies that doesn't have really any exposure to AI, and their business is going great, but they're definitely getting a boot. Like I think when Nvidia had its May report, they definitely took off, and the whole semiconductor complex has traded higher, and so I'm definitely benefiting from that. Dropbox, I mentioned, they're getting some tailwind probably. Taiwan Semiconductor, which I own, actually, I don't think has gotten a ton yet, surprisingly. And then I own VMware, which Broadcom is in the process of buying. And so they're in that picture too. I say I wouldn't because for two reasons. One is that there's just a lot of companies that are saying they're AI, like even going back to Dropbox, like I don't distrust that they're trying to do it. I'm skeptical that it's really going to move the needle that much, except investor sentiment. So I'm not going to invest for it because of that reason. And then if it's a company that's really focused on that, it's probably going to be something newer. It's probably going to be some new feature that wasn't previously, that may not be market tested and market proven to where I can see a financial track record. And by the time I see that financial track record, the valuation is probably going to be beyond where I'm comfortable. I'm not opposed. I'm not anti AI, but I would be surprised if that was the reason I invested.
I think AI will definitely play a role in all types of businesses. I do think that it's going to take away a lot of jobs. I truly believe that it's going to raise the education level. And I think the education sector is going to focus more on teaching the young generation on coding and so on and so forth. It's definitely going to be more competitive, especially in the tech space. And talk about the subscription economy. I think AI has to go with the subscription economy because I think it just makes the most sense in terms of generating the most revenues. This is just my opinion. It's not going to be easy to educate someone to know how to use AI. I think that's the thing that I'm cautious of. You know, if I were to teach my parents to use an AI software, there's going to be a lot of challenges there. I don't know if you think differently.
I won't throw the person under the bus, but there's somebody in my life who's a little bit older than me who will ask me about something and I won't know, but I will know how to Google to get the answer, right? And so AI to some degree, using generative AI as a replacement for this in one way is going to be something of a similar skill. I'm sure you saw what earlier this year when the hype was starting, everybody AI prompt engineer is going to be the next new job. And I don't know, maybe. I think it's more like Google where you're just everybody's gonna have to learn if it helps them how to incorporate them. Wikipedia is another example, by the way, of this, where when I was in college, I remember hearing a professor say, or hearing an anecdote. I don't think I was in the class for this, but of a professor saying, here's why I don't trust Wikipedia. And then he changed it right in front of our eyes. But Wikipedia still is ultimately a pretty good first source for a lot of things, and it's silly to ignore it when it's so wide spanning. We'll see. I respect that a lot of people are calling it revolutionary. I do think it's much more real than a lot of the buzz that's come before. 3D printing, I think, has been a lot slower. Crypto has never shown me, or blockchain has never shown me a similar impact to AI. My nature is to be skeptical and to doubt the newest thing. And I want to be more open minded about AI. I think it'll take time for it to really play out. I think job losses that may have happened yet are premature. I think it's just people using that as an excuse to try something. One more example, I got onto Delta's customer service yesterday for something, Delta Airlines. I wrote a message because I thought it was more of a direct channel. I wrote a message that was thoughtful, but my thing, AI bot came on, was completely unhelpful. So it forced me to like jump through the two hoops and then said, okay, I'll put you on with an agent with your question. And so at the end, the agent was ultimately very helpful. I rated them a 5 and I said the AI bot was 1. Like it just wasted my time. And maybe they wanted to stall. So yeah, TBD, I guess. I'm sure people, smart people, will make good use of it. I'm sure less moral people will either use it as an excuse to cut jobs or will use it as a way to pump their stock. And so our job as investors to sort between the two and see what the real impact is.
And do you think that AI should go with a subscription model? Do you think it should go with a monthly subscription or yearly subscription? How do you see in terms of retaining customers for the long term?
I think ultimately OpenAI and Microsoft will provide ChatGPT via subscription model of some form. I suspect they will probably have more success figuring out enterprise applications. And I'm thinking off the top of my head a little bit, but my implementation, for example, is still probably going to be some sort of financial service provider will figure out a way to charge me 9, $10 a month. Let's say that's all I want. They would charge me $10 a month for it or whatever. And I would need that as a value. So yeah, I do think it'll ultimately be subscription. I used ChatGPT this week for the first time in a while, and I noticed they're doing more aggressive sample prompts than they were doing before. And I've seen different reports of how expensive it is to run their models and so on. So we'll see how that is. But they're starting to be more aggressive about we need to actually find the product market fit. We need to find who is going to use this, how, and tailor this to them. And so that's where I say I can see them starting to go to companies that need to use this for coding and selling large package subscriptions rather than expecting, now that the buzz has worn off quite a bit and now that you and me might not be using it as much, they're not going to try to sell it to you and me as much. They're going to try to go to enterprises. To your point, ultimately the most likely packaging of that is as a subscription. And I guess the other point that we haven't touched on for AI, where the whole principle of machine learning and so on is that they're actually improving over the time, then yes, a subscription model actually really, in theory, fuels itself and improves the product for both the user and OpenAI or whoever the provider is.
I want my audience to understand your investment philosophy and your learnings over the past 2.5 years. I think that's also a big part of my podcast episode. The end of each episode is asking my guest speaker what was their biggest investment mistake or takeaway.
It's a great question, and it's always good to reflect. For me, the big learning was to trust my instincts a little bit more. I tweeted out a little while ago an article I read that was really good. It was a review of books written by, one was about GE and then one was written by Dave Cody, who is the former CEO of Honeywell. Cody apparently talks in his book about the importance of intellectual rigor. And he talked about the company, maybe a unit in the company, and how they kept spending more, not because they were dumb or bad people or anything like that, but just because there was no like rigor in terms of their decision making. And I think that's something that I need to apply more of, to really say, okay, should I have known better? And how that applies to my investing I don't think I made a ton of terrible buys. And buys, you make mistakes. One example, if we didn't talk about it on the podcast last time, I think we talked about it offline a little bit, was Just Eat Takeaway and the delivery space. And I sort of tried to invert. I saw there was a ton of competition, and I tried to say, well, but that must mean there's a golden prize at the end. And I skipped over how painful competition is for an investor. And that was a bad investment. I could have been harder headed about it earlier, and I could have recognized the mistake earlier and and cut my losses sooner. Selling, I find much harder than buying. Figuring out when to sell in the 2021 era, the idea of hold on to stocks for a really long time and really stick with them, and stay with them forever because they're just going to continue to compound and so on, right? That concept, it doesn't apply to every stock. Buffett wants to hold stocks forever, but he doesn't. He will sell stocks, or Berkshire Hathaway will sell stocks in a shorter time period because they get it wrong, because things change and so on. And for me, I think remembering that sometimes there are companies that you just need to not just take profits, but you'll move on from when they reach a certain price. I had this funny little company that's a dredging company. They dig up sand underwater to expand canals, reform coasts, whatever, Great Lake dredge and dock. And they reached what I considered a fair value of $15 a share. Like I could tell a story of wind energy and the infrastructure plan in the US and so on. Like they kind of performed to the point of my thesis. I should have moved on. And then they had a couple of bad reports. And all of a sudden I realized it's the opposite of a subscription business. It's very project based, and then costs overspan and so on. And so I think that's where straying from principles about, okay, sometimes you need to just, you want to own a stock forever, but not every stock is for that. And you can still get value. You can still hold a stock until the multiple changes or until it gets to where you want, and sell and move on. I think holding on to stocks to avoid having to pay taxes is a big mistake that I've learned over time. You will save yourself money by paying the tax and selling as compared to holding and losing as the shares go down, which is a potential. I've been in the game now for over a decade. I've seen a lot from my time at the different media companies. I will continue to make mistakes. I don't claim to be any better than anybody else as an investor, but I have a pretty good instinct for knowing when somebody is talking BS, and then also for in my gut based on facts, knowing when something I should move on from something. And so trusting that a little bit more is something that I would say is the biggest mistake. I've not trusting enough has been the mistake I've made. And that's something that I'm working on this year and hopefully in the years to come.
Thanks so much for sharing your humbling experiences. I know you've been educating the community or sharing your experience with investing. And I know you recently launched the short investing guide. Can you tell us more?
Thanks for asking. It's just a series of videos and articles. I have a website called shortinvestingguide.com, and I have a YouTube channel. I would hope the videos were shorter, but ultimately they're about 10-minute videos where I'm just sitting in my chair where I am now, talking about working through a curriculum on the market. I lead people up to the point of how to index, which I think for most people is enough. But then if you want to learn more, right now I'm working on how to buy stocks and all the different steps, how to buy stocks, where to get info, how to evaluate a stock before you buy it. I'll go into the mechanics at some point. How do you buy a stock? I'm trying video format and trying to put myself in the center spotlight rather than, on the razor's edge. I'm more of the play-by-play guy who's talking to Akram's razor about his ideas more. Sometimes my ideas will come up, but I think he's more central to that. And at my role as seeking alpha and investing.com, I've been behind the scenes. So I'd like to experimenting with putting myself on the line and what I know in front and force myself to get it right. For people who are not investing at all, try to make it less intimidating and not try to sell a false bill of goods, not say this is easy, this is how you're going to make $1 million, but this is approachable, this is attainable, it's something that you can do, especially if you stop at indexing, but even if you don't. And then also just try to, like we were talking about in the last episode we did, really what to focus on. And there's, again, with so much noise and with so much, everybody's excited about what's happening today or tomorrow, just to simplify what matters and what will hopefully be tried and true principles. Doesn't mean that I won't learn more and that people won't learn more, but just the basics of how you would think about investing. And so I'm hoping that's what I'm trying to achieve. It's very small scale right now, but that's something for me to try to also learn how to grow that audience and see how it becomes useful.
If your audience could only learn one thing from your guide, what would you want to say to them or make them learn with regards to investing?
Beyond the fact that it's approachable and not this exotic thing, and I think that's the magic of a Peter Lynch, for example, is connecting what you see in the world to how you invest. But I think understanding what long-term investing means, there are a lot of people out there who talk about long-term investing and preach it, but then you still see, because they're on social media, because they're still in the day to day, and they're all often in the same sorts of stocks. They're all sort of in these stocks, buy and hold forever. And who cares about valuation? I think on the one side, there are the people who talk long term investing, but then leave the actual analytical rigor on the cutting room floor. They don't actually study the stocks, they don't actually understand the companies, I think, often. And then on the other hand, there are people who are really in the weeds, but get so caught up with the market's up or the market's down, and they kind of forget that none of this matters. Like the principles of long-term investing are right, but you shouldn't lose the point that the long term is a series of shorter terms. I don't think that's days per se. I think that's more like 2 to 3 years, like we were saying earlier. If you think that you know what's going to happen longer term than that, I'm skeptical. But marrying those two things, I think it's right to say ultimately my goal is to grow my money over the long term so that I can put my kids through college, so that I can retire happily, so that I can buy a second home, whatever. You don't have to be a hedge fund manager. You don't have to be an MBA student or a CFA to really be able to analyze a stock, but to understand, okay, what am I paying for? What does the company do? What value do I get out of the company? What can I expect in the next 2 to 3 years that's reasonable? So I think that's the big thing. Like really long-term investing, I think sometimes comes off with this sheen of, all right, so I'm just going to invest in Nvidia. Nvidia is a monster and it's going to be a monster forever. And it leaves off the actual, and not just the valuation, which is the easy part, but okay, what is their business looking like? What will it be? How sustainable is this buying of GPUs to train AI and that sort of thing? And really, how likely are they to maintain their lead? And I don't have a strong view on NVIDIA. I don't know if it's overvalued or not, but I think so often it's easy to say, well, NVIDIA went up, so it must be a great stock. It's a compounder. It'll continue to go up. And I think that leaves the analysis aside. And so I think that's the right focus is the long term, but it comes with, you have to understand what's happening now and what's likely to happen in the years ahead.
Thanks so much for sharing your insight and your learnings. And I hope our listeners will follow you on your social media accounts. So for them, how would they be able to find more information about you?
These days, go to shortinvestingguide.com, and the YouTube channel is where I'm most active right now. I'm still on Twitter. We'll see how much longer that lasts. I think I've been quieter there. I'm at Dan Shvartsman on that. So yeah, I would say just the website. I publish every week. I publish on Monday a new post, which is essentially the script for the video, which is also embedded. So the video is available on Mondays. I have to start filming again. I filmed the backlog before I took a vacation for the summer. So now I have to start up again, but I have one more video going out next Tuesday, and then I'll start filming. I may also play around with doing like a weekly video about the markets that's a little bit looking at what's happening short term, but trying to put it in a longer term context. So yeah, those are the places to find me.
Looking forward to that. Just for disclosure purposes, do you own any stocks that we've mentioned? I know we've mentioned quite a few companies.
Dropbox, Booking, VMware I mentioned, which will become Broadcom, I suspect, before too long. Taiwan Semiconductor I did mention as well. And I mentioned Berkshire Hathaway. I own Berkshire Hathaway shares. I have Apple shares too. Thank you so much, Kelvin. It's been a blast.